In a recent blog, I talked about the dimensions of higher expected returns, that being the equity markets over the fixed income markets, small size companies tending to outperform large company stocks, and value stocks outperforming growth stocks, that all being in the equity side. And then on the fixed income side, we have average maturity and average credit quality. In summary, here is a slide that just shows those numbers. From 1927 through 2012, the market premium, that is the stock market over U.S. Treasuries, outperforms on average 8% a year. Small company stocks outperform large company stocks by just under 3.6% a year. Value stocks outperform growth stocks, as defined by price to book, just under 5% a year. And then in the fixed income space, longer maturities tend to outperform shorter maturities by 2.5% a year, and lower quality tends to outperform higher quality by just under 1% a year. So you can actually manage these, and when credit spreads are wide, you can invest in lower quality stocks. When credit spreads are what they call narrow, it would pay to invest in the higher quality names, because you're not getting paid to take that incremental risk. Similarly, when the yield curve is steep, it pays to extend your maturities somewhat. You're getting paid to do that. But when the yield curve is flattish, it pays to stay short. You're not getting paid to extend your maturities. But back to the equities for just a little bit. So how does the small cap value strategy play out over time? Here is July 1926 through December 2012 for 5, 10, 15, 20, and 25 year periods of times. These are rolling average periods of time. If you start at the shortest period and looked at every 5-year period between 1926 and 2012, value beat growth fully 80% of the time. So if you look at the 5-year period of time, value beats growth fully 80% of the time. So 80% of every 5-year period, value is outperforming growth. And then as you extend the time, of course, you start to appreciate 91%, 95, and then in the longer periods, effectively every 20 and 25-year period, value beats growth in the United States. Small company over large company is not quite as prevalent over the 5-year periods. Small beat large 60% of the time. But let me ask you, if you were going to Las Vegas, would you take 60% odds? You would just keep playing the bet, right? Well, that's essentially what you're doing with small cap over large cap. Over the 10-year period, you're 75%, and again, you're going all the way up to 97% of the time. So there's probably one 25-year period between 1926 and 2012 where small did not beat large. I don't know which period that is, and if you had found it, it would have been like finding a needle in a haystack. Same for international. Now we're looking at international value versus international growth, only it's more prevalent, more persistent. Starting out over 5-year periods, 96% of the time, value beat growth, and it gets up into 100% of the time for your 10, 15, 20, and 25-year periods. Small versus large, again, internationally more prevalent. Why wouldn't you want to invest this way?